Hello, everyone. Welcome to today's speaker series. Today, we are joined by Huw Davies. And correct me if I actually got your name correct in terms of spelling, Huw.
No, yeah, I believe so, yes. Yeah.
Okay. Okay, that's fair. He works as, as a strategist at Jupiter Asset Management. He works and leads the strategy and the Jupiter Strategic Absolute Return Fund, which leads us, or which I'm assuming will lead our conversation today to focus specifically on fixed income, which is your realm of knowledge and your realm of work. And more specifically also in terms of developed markets and what your perspective is on those and how you have been targeting and assessing your asset allocation to sort of face a more disruptive start of the year than what we had expected, right?
Yes, very much so.
So
yeah, I don't know, maybe I could start off by just sort of outlining how we see the start of the year. I think in a way, last year was obviously a difficult year for financial markets, but actually for us, it was clearer in terms of the direction that we were going. Because at the beginning of the year, if people remember back to where we were sort of this time last year, we were in an environment where markets were predicting or certainly discounting peak rates in the US to be somewhere around maybe 1.5% or so. In our perspective, that was a long way away from addressing the inflation problem, and therefore we expected a significant reevaluation of that peak in rates. We didn't quite know how far it would go, but certainly somewhere around sort of 4 to 5% was the sort of initial target that we thought that that rates might, or certainly the peak in Fed funds might have to get to. And now we've obviously gone on that journey over the course of the last year, and now we're in an environment where I think the outlook for 2023 is much more uncertain. Rates or yields across all markets, whether they be developed markets or emerging markets, have moved to quite substantially higher levels than we've seen for quite a number of years, over a decade or so, maybe more in some markets. And therefore, we're in an environment where yields look attractive, but there's still an awful lot of uncertainty about where inflation and central bank policy may go over the course of the next 12 months or beyond that. And therefore, in a way, we find yields attractive, but are not sure. In fact, we doubt that markets have fully priced in the end of the rate hiking cycle and how much of a problem inflation will continue to be over the course of the next few years, rather than this, I suppose, particularly in the middle part of last year, a sort of very nice and very neat return to trend or to target levels of inflation. And I think that's the big problem over the course of the next 12 months and beyond that the markets face. And I think we've already seen that in the first couple of months of this year, a huge rush of investment into fixed income markets in January, and a very big reversal of that over the course of February. In fact, if you look at things like investment grade paper now, in terms of its returns for this year, is about pretty much unchanged over that period of time. And obviously we've seen a huge rally in yields and then a massive move back in yields and a big debate going on about what policy will be, what growth will look like for this year. And therefore the level of uncertainty is pretty big within markets. And I think that's one of the things that we're really looking to address and try to manage, certainly over the initial course of the year. But I think we're going to have to manage it definitely over 2023 and probably well into 2024, this elevated level of volatility that unfortunately I think we're going to have to get used to.
I was actually going to add to your point that I saw on Bloomberg, on Twitter, a couple of weeks ago, this graph where an analyst was pointing out the fact that the levels of the 10-year treasury were unchanged from the beginning of the year, and we were about mid-February. And this is sort of like very related to what you were highlighting before in terms of the inflation problem and the inflation narrative, and how this has been intertwined directly with monetary policy. So why don't we sort of delve a little bit deeper into that specific thing? You mentioned before that your take was that you were sort of like one of the trailblazers in understanding that monetary policy was not going to be as low, if we can say it that way, as the market used to believe at the beginning of 2022. So are you on the boat of those who believe that the peak rate for this year could be close to 6%, especially after like Powell's statements yesterday and the day before in Congress? Like, what is Jupiter's take, specifically speaking, on monetary policy? Are you more, like, is your take a little more of an even flatter curve? Are you looking into even higher short-term yields? Like, do you want to delve deeper into it?
I think it's nice of you to call us a trailblazer. I'll be maybe slightly more humble than that. I think over the course of last year, I think it was understandable in a way that the market was of the opinion that we would sort of have a limited, or certainly a truncated, tightening cycle. Effectively we've been used to, since effectively the global financial crisis, which was now the best part of 15 years ago, we've been used to very, very low rates. Obviously 2022 is very different to that, but we've become used to two things. I think very low interest rates, very little volatility of rates, and any period like 2018 where we've seen a rise in rates, that a very quick reversal to this sort of very low and cheap money status. So in a way, the market has sort of got used to that situation, and therefore sort of being in the process of predicting a sort of sustained and extended rise in rates, I don't think was in most people's mindsets. And obviously we were moving from a position where, and we were in the same camp, that we really felt that, I suppose more so in 2021, that a lot of the moves in inflation that we were going to have were very transitory, that a lot of these things would break out of the system. But I think the extended process of inflation being embedded within the system, but also leading into an environment where we had a very tight labor market, and a movement in average earnings or earnings, and this isn't just something in the US, this is across the globe, where workers have been or labor has been in an environment where they've been able to ask for higher wages, not necessarily to keep pace with the very aggressive level of inflation, but certainly mitigate the rise in inflation. In that environment, I think that is what has created the problem in 2022 about all central banks, but obviously led by the Fed, having to address transitory inflation, mainly around energy and food, moving into inflation at the core level. And I think that's the big change or mindset that the market needs to get its head around. I think even now, when we talk to a lot of analysts and actually other investors within the marketplace, there's this sort of idea that inflation is in some sense going to evaporate, that once headline energy costs come down, that food prices start to stabilize, that this underlying core level of inflation is literally just going to move out of the system. And we find that unless we have certain things happen, and in particular about a tighter monetary policy on an extended period from central banks, we find it very difficult that average earnings are going to, or certainly this core inflation problem is going to move out. Now, if you look at core inflation in the US, it has definitely come off the top, but it's still at very elevated levels, around 5.5%. If you look at Europe, for instance, core inflation has risen to around 5.5%, 5.6%, and it's stayed there. There's no rollover at all in terms of the process in terms of the core CPI numbers. So I think this is the biggest problem. It's not so much, from our perspective, the debate is not so much about where the peak in rates are. Obviously, we've got peak rates in the US being sort of discounted somewhere around 5.6 or 5.7% now, which is obviously a significant increase over what we've seen in the last couple of months. But it's our sort of analysis is not so much centered about where peak rates are, but where rates are in over the course of the next 12 to 18 months. Is that I think central banks realize that they're not going to have an easy ride in terms of where their inflation profile, particularly at the core level, is going to go. And therefore, it's, although I think, what the market is pricing in, particularly might be a little bit low relative to what we actually experience in terms of US and European rates. But actually, the big disagreement that we have with the market is how long they're going to have to stay there for. Because at the moment, I think a lot of people, particularly in the second half of last year, really believed that the global economy was really going to struggle in 2023. And we never really believed that. And the reason why we didn't really believe that is that we didn't see any, although we obviously saw some weakness in various parts of the economies, the major economies of the world, particularly around housing. What we didn't see is any weakness in the labor market. And therefore, for us, the real downturn happens for any economy, but particularly for the global economy, but as I said, for any major economy or any economy indeed, is when you have concerns or that households have concerns about their employment prospects. And if you look across Europe, if you look across the UK, you look at the US and various parts, all the major economies of the world, there is no stress about whether people will have a job in the next 6 months or so, because the labor markets are so tight. So if you've got a certain or some security around your job profile, and obviously we've seen in the tech sector, we've seen, there's a lot of headlines that are made about job losses there. But I think if you look at the labor market as a whole in aggregate, particularly within the US, but this is reflected also in Europe and in the UK and in a lot of other economies, the demand for labor is well in excess of the supply of labor.
Yes.
And therefore, even if you've had, and therefore, if you take the US, for instance, you've seen a big rise in mortgage rates, but households are effectively on 20, 25-year fixed rates. So plainly moving house or trying to buy a new house is a particular problem. But for anyone who's got a job and who's got a fixed rate mortgage and doesn't have to move, then life is more difficult. Life is more difficult than it was 12 months ago, but it's not a problem. And therefore, this is quite a strange economic cycle, because if you look at particularly housing, and if you look at previous recessionary processes, the downturn on housing has normally been associated with a rise in unemployment, and therefore that sort of feeds off each other. People get concerned about the outlook for employment. They're concerned about their house prices. They try to maybe sell into that process, change their lifestyle, certainly pull back on spending because they're concerned about the house price. That is not happening. And that's why we think that consumption, maybe more in services than it used to be in goods, but certainly consumption in aggregate has remained relatively strong. And now, despite the fact that most people felt that quite a few economies were going to experience a recession in 2023, we didn't feel that, and we never predicted that. We're now moving into a period where those forecasts are starting to ease into not strong growth, but sort of solid growth levels into 2023. And then we have the potential, and this is still uncertain, but the potential for a larger growth profile coming from a reopening of spending from China. So all of that prospects creates a much stronger growth outlook for 2023. And I think that's one of the reasons why risk markets have continued to hold in quite well, despite the concerns about inflation and central bank policy. But it creates a very big problem, I think, for central banks over the course of this year about what they need to do to control that inflation dynamic.
Yeah, and to your point, central banks are not only going to have to deal with the happenings and the effects of, let me be redundant, second order effects and inflation, which it's what you were highlighting before in terms of seeing sort of the stickiness of core inflation in general that does not recede. even if we have the highest rates that we have had in, as you said, over 15 years. So we're both on the same ground by believing that consumption is going to remain robust, even if this is going to be sort of like a factor of pent-up savings that were sort of accumulated over the pandemic. However, the savings are supposed to come to an end. So are you, I mean, considering what you just said about having a strong growth, well, not strong, but like sort of a stable level of growth and not a recession, at least for the main economies or the G10, is that your perspective of like for the future 24 months? Are you expecting the US to sort of endure and come to the soft landing that Chair Powell would love to see? Or are you more on the side of maybe he's not going to be that lucky and we're going to endure at least a couple of quarters where maybe we can face negative growth and then come back to a more positive trend going forward? Like, what would be your take on specifically US growth?
I think the biggest problem, well, our perspective is very much that at some point the US is, if the Fed is going to control inflation and bring it back down to target, we're going to have at least a mild recession. And we're going to at least have to see what we would consider to be a break in the labor market. And obviously we get a bit more data on that, or quite important data on that tomorrow, from the non-farm payrolls numbers. And potentially that will need to be included with a break in risk markets, i.e. some retracement in risk, in a further retracement, I should say, in risk markets. And in that is the way that the Fed controls inflation. I think one of the reasons why we've seen February be a much more difficult month for markets, particularly fixed income markets, is one of the things that we've seen, particularly at the front end of the inflation market. This is the price market inflation market rather than the actual data, is that we've seen a pretty significant surge in the pricing of sort of 2 to 3 year inflation in the marketplace. And that is because, or we believe that is because central banks have been indicating, and certainly Jay Powell's press conference in January suggested that they were getting, obviously the move back towards 25 basis points, but also the tone of that press conference was very much sort of on the more dovish side.
Yes.
And therefore this was preparing the market for the pause in interest rates that a lot of people have been hoping for, some expectation for cuts in the second half of 2023. And therefore inflation markets were like, core inflation is not fixed. The Fed's getting ready to pause. 2-year inflation is cheap. And therefore you saw this you saw this in Europe and in the US. 2-year inflation started to move quite considerably higher. And that is what I think caused the concern within fixed income markets, that the job was not done. And therefore, if the Fed or central banks generally were not going to address the problem, then maybe the markets had to. So I think that was the big change that we saw, and I think that in a way is the dilemma, and what we're going to have to manage over the course, or manage risk over the course of these next 12 months, is that we are caught between, if the Fed doesn't address the inflation problem, then inflation pricing within the market is going to move higher until we see some break in the labor market. And that's why, from our perspective, and we've been saying this for, if anyone who's been reading our commentary, they will know this, that we believe that the labor market data, not just in the US, but I suppose it's predominantly in the US, but the labor market data is so important. Because if isn't there a break in the labor market, and it's extraordinary, to sort of go slightly back on myself, I think if you take the process back 12 months and you'd said, we're going to have, basically the market is going to start discounting 5.5% interest rates, but the labor market won't break. The unemployment rate will be pretty much the same, and the last non-farm payroll print would have been over 500,000 jobs. You would have gone, you're mad. You know, that process of moving rates that much higher over a 12-month period for the fastest or tightest or most aggressive rate rising process or hiking cycle that we've seen, for the best part of 30 or 40 years, there's no way that the labour market can cope with that. So that would have been our view as well. But the fact that the labour market has not broken in any way, shape or form, it's remained solid, and if anything, has got tighter. That would be
I was
ours.
just gonna say that we're I mean, correct me if I'm wrong, but in my understanding, we're reaching a point where the unemployment rate is getting closer to all-time lows again, and hiring continues to be strong, and specifically in sectors that were abated by the pandemic more than others, hospitality, leisure, which in the end just ends up people to consume even more in services than they did in goods. So I feel that it's sort of everything intertwines in this same dilemma of how do we like put brakes on inflation, but we allow also people to consume while not damaging the inflation market, the job market right now. Like, I seriously would not want to be in Powell's shoes right now, if you ask me.
No, I mean, it's not. It was interesting. I was listening to a podcast the other day, and I can't remember who'd asked the question, but they asked some years ago, obviously, but they asked Volcker how monetary policy controls the inflation process, and he said it's quite a quote. He says, by creating bankruptcies.
Okay.
So you create weakness in the economy and bankruptcies, and that's how you control it. I mean, it's a pretty brutal way of doing it, but obviously, he was a pretty brutal and forthright in the way he adopted monetary policy or conducted monetary policy. But I think going back to that point, it is a very difficult situation for Jay Powell and the rest of the committee. But the fact is that and my favorite measure for the labor market, particularly in the US, is the claims number, because it comes out every week. And actually, if you look at the 4-week moving average of that, which I think is probably, rather than looking at the spikiness that you get, that number is below 200,000, and the all-time low in terms of that 4-week moving average, well, certainly for the last 30, 40 years, I haven't gone much further than that, is 171,000. So we are so close. I think that the 4-week moving average at the moment is like 192 or something like that. So it has ticked up a little bit in the last few weeks, but obviously it's come down and then ticked up a bit. It's right down at the lowest levels we've ever seen during any cycle. And normally when you have for that number, normally if you're going into a sort of recessionary period, you have weekly numbers at 300,000 or 400,000. Those are the sort of numbers or higher that you get. And therefore, for me, given it's such a regular update of the labour market, I think it's probably one of the best metrics you can see, rather than non-farm payrolls is obviously monthly. So
and it also gets revised less, at least if you ask me, because the revisions on the non-farm payrolls tend to be a little bit brusque sometimes.
Yes, exactly. And there's a lot of the payroll data is, as you say, are subject to sometimes quite significant revisions on a basis. So for me, it's the best, one of the best. I think it's one of the best pieces of economic data that I look at, because it gives such a regular update of the labour market, and the labour market is such an important part of the US economy. So, and I think at the moment even more important. So, as you say, Jay Powell and the rest of the committee are in a very difficult situation. If they're going to control inflation, particularly if they're going to be true to their word about returning inflation to target within they're going to have to create a rise in unemployment, unfortunately. And I don't say that with any glee or anything, but because that's obviously for some people going to be a very difficult process. But inflation is not going to evaporate. That's not the way inflation happens, and therefore we have to create some level of weakness, or the Fed have to create some level of weakness in the economy to be able to allow it to happen. And that is a painful process to go through. Volcker realized it back in, he had a much bigger problem, obviously, from an inflation perspective, but he realized that he had to control inflation after the mistakes that were made by pretty much all central banks around the world during the 1970s. And from my perspective, the profile that a lot of forecasts have in terms of inflation getting back down or back down towards target are, in a way, the best case scenario. And I think what we're going to have to get used to in financial markets is two things. Is one, uncertainty and volatility of inflation, but therefore also uncertainty and volatility in central bank policy, and also therefore in bond markets. And that's a very different situation to what we've been in the last 15 years. And I think that's why, you know, in a way, that's what our strategy is trying to do. We're not saying that we have a crystal ball and we know what's going to happen, but it's very much about trying to risk manage that process, or certainly risk manage investors' allocation to fixed income. It's trying to risk manage that. In a way, there was a very good article actually I read. I wish I can remember who wrote it, but that I read back in October of last year, where the author was basically talking about us moving from an environment of asset ownership to asset management. In a way, in the aftermath of the global financial crisis, when interest rates were so low, but also had no volatility or very little volatility, you just needed to own assets, whether it be credit or equities or private equity or anything. You just owned it. If there was a backup in pricing, you just own it, and it delivered low volatility and pretty good annual returns.
That's true.
Now, with the uncertainty about inflation and the uncertainty about interest rates, we're moving into, I think, from an investment perspective, and this goes for all asset classes, a period of risk management. Within those asset classes, you have to find strategies that can manage that risk, because the macro is now very uncertain, and therefore the path of interest rates, the path of inflation, and therefore the path of the price of money is very uncertain, and you have to manage that risk process. And that's what we're trying to do. It's not easy, and it's a very difficult market.
Definitely.
That's effectively what we see our job as being for our investors, is to manage that risk, deliver low volatilities, good risk adjusted returns, and manage their risk profile in a diversified way in fixed income.
So if I can sort of like piggyback on what you just said in terms of risk management, and if I can ask about asset allocation, are you now more inclined towards having exposure, for example, to shorter term securities, shorter term investment grade paper? Are you favoring sovereigns over credit? Like, in what you are allowed to say in terms of asset allocation, what has been your preferred risk hedging strategy for Jupiter in general? Because
certainly over the last 12 months, we've been generally not at all times, generally short of duration. We are certainly still short of core duration. We've generally not owned credit for the last 12 months. We did go a little bit longer credit in January, but have flattened that out now. To us, again, credit spreads look pretty tight, and therefore I don't think we're, for last year we ran short positions in credit. That's quite difficult now because of the high yields that you can get in there, and therefore being short of a high yielding asset is difficult, and therefore we prefer to be sort of flat rather than necessarily short. Because of the better growth profile, we do like certain areas of the emerging market world, particularly if we're going to get an increase in Chinese growth, and global growth may not look so bad. But yeah, generally we're sort of short of shorter dated maturities, if I can say that. We believe that that the growth profile at some stage is going to need to be addressed, and therefore, despite the shape of the curves, we're still in sort of flatness, because we think the growth profile actually has to be suppressed to control inflation, and therefore it will need to be suppressed by higher yields in the front end of the curve. that's our sort of perspective at the moment. So we're not particularly short overall of duration, but we're sort of neutral of duration with flatness on is probably the best perspective that we have. But it's a very uncertain, as I said it right at the beginning, I think 2022 was in a way, it wasn't an easy year, but it was an easier year because we were on a journey from A to B. We were going from very low rates to what we consider to be much higher rates, and obviously we had to manage that process because it wasn't a linear path that we went on. So we had to manage the sort of ebb and flow of that macro theme. But for us, it was a fairly clear macro theme over the course of 2022. This year's going to be, I think, more difficult because there's going to be periods of, and I think the last couple of months are what we are likely to experience, periods where we see maybe quite strong fixed income markets, and February when we see quite weak fixed income markets, and we're going to have to, work through and manage that process. So I don't think it's going to be an easy year, but sort of our longer term or medium to longer term view is that at some stage the macroeconomic outlook is going to have to deteriorate if they're going to control inflation, and therefore at some stage we're going to have to see higher rates, cheaper credit, probably risk markets break a little bit, and at that stage, once they start to control inflation, quite a lot of assets are going to look cheap, but we're not there yet.
Example.
We're not there. We don't think we're fully there yet, and I think obviously the market felt that we'd reached that point in January. We were a little bit long of duration in January, but we were sort of reluctant bulls because I think further down the line we could see the problems coming through for the market, and therefore, we were very close to home, as it were, in terms of managing that risk. So yeah, I think that's our outlook, is that the growth profile at the moment looks quite positive. Rates are going to have to go higher. They're going to have to stay high for longer, and at some stage that's going to lead to an economic downturn. But I think that's probably back end of this year, maybe the beginning of 2024. So we're going to have to deal with higher rates for longer than most of the market with either like or hope.
Okay, if I can allow myself to one follow-up question to what you just said, and then we'll open to the public. You said emerging markets, and actually one of the things that we highlighted in our quarterly call that was presented in January is that emerging market debt was starting to look more attractive than developed market debt. Do you have any particular, in very colloquial terms, darlings within the EM space that you would like to highlight, or how's your allocation specifically on EM terms?
Yeah, we tend to like. I mean, one of the factors, particularly within our market, is that within our strategies, we like to stay in the more liquid elements of the marketplace, and therefore, if we're going to have emerging market exposure, we want to make sure it's the more liquid end of that process. So we've tended to be exposed to things like Mexico. We've liked quite a lot. Mexican bonds we like quite a lot, and Indonesian bonds, for instance. That's probably our two largest exposures within emerging markets. I think one of the things we've taken that back a little bit over the course of February, because we are a little bit concerned about what is going to have to happen to interest rates over the course of this year, in terms of what the market's going to have to price in later on, and therefore how risk markets will react to that. And plainly, if you look at emerging markets within the context of other risk markets, whether it be credit or equities, there tends to be quite a strong correlation with that. But for the time being, if you look at some of those markets, the yields on them are pretty high, and therefore, a little bit like my point I made about credit, it's quite hard not to sort of, in a way, certainly be slightly long of those sort of markets, just because they offer so much yield, particularly within the context of if we think that the global economy is going to do quite well, and those economies may well be in an environment where they do quite well, but also quite a lot of those economies have sort of addressed some of the inflation problems early, and some of the real yields in those markets are quite attractive as well. So yeah, we're sort of cautiously optimistic about EM, but realize that, you know, our longer term view is that risk at some stage probably comes under a bit of pressure, and therefore, you know, that EM markets have to be within that context. But yeah, those, we tend to like the sort of more liquid elements within emerging markets, and those are a couple of the currencies or a couple of the countries that we've sort of favored certainly over the course of the last few months.
Insignia Financial Group LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services LLC, headquartered in Puerto Rico, and through Insignia Securities LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Advisor Public Disclosures website, https://advisorinfo.sec.gov/.